At 3:17 a.m., oil stops trading normally. Not slowly, not gradually. It gaps. Brent jumps $25 in minutes. WTI follows. Futures hit circuit breakers before Europe wakes up. And here's the detail that matters. Tankers freeze in the Strait of Hormuz. No official declaration, no signed closure, just drones over water, missile alerts, insurance suspended. 20% of global oil flows through that narrow corridor, 17 to 20 million barrels per day. There is no alternate ocean route. And this didn't happen in isolation. Hours earlier, a coordinated U.S.-Israel strike hit deep inside Iran's power structure. Leadership disruption, military infrastructure targeted. Tehran vows retaliation. Then shipping halts. And when shipping halts in Hormuz, markets don't wait for press conferences. They price worst-case scenarios. Here's the number you need to remember. 102 million barrels per day. That's global oil consumption. Remove even 8 to 10 million barrels from the market, and pricing becomes violent. But oil is just the visible shock. The invisible shock hits the bond market first. And that's where this becomes something much bigger. Because this is not just a Middle East flare-up. This is the kind of moment that fractures systems. And once systems fracture, alliances shift. Here's what most people miss. Oil shocks don't kill economies first. Bond markets do. Before stocks collapse, before banks wobble, before headlines scream recession, bond yields move. The U.S. enters this crisis with over $34 trillion in debt, annual deficits near $2 trillion, interest payments approaching $1 trillion per year. Now add $170 oil. Inflation expectations surge overnight. The 10-year Treasury jumps from 4.3% to 5% in days. And here's the math nobody can ignore. Every 1% rise in average borrowing costs adds roughly $300 billion annually in additional interest expenses over time. That's not theory, that's arithmetic. Now ask yourself, who buys that new debt? China has been reducing Treasury exposure. Japan defends its currency. Emerging markets need dollars to stabilize their own systems. Foreign demand weakens precisely when U.S. borrowing needs expand. And this is the moment where the Federal Reserve gets trapped. Raise rates to fight oil-driven inflation? You trigger recession. Cut rates to protect markets? You weaken the dollar during geopolitical crisis. There is no painless move. And when central banks lose room to maneuver, global confidence erodes. But here's the deeper question. If Hormuz stays unstable for weeks, not hours, what happens to global energy pricing? Because oil above $150 is not temporary discomfort, it's structural stress.
Let's strip emotion out. 17 to 20 million barrels per day transit Hormuz. If half that is disrupted, the world loses roughly 9 million barrels daily. For perspective, during the 1973 oil embargo, the supply shock was around 5 million barrels per day. This would be nearly double. The U.S. Strategic Petroleum Reserve holds roughly 350 million barrels. At 5 million barrels per day emergency release, that's 70 days of partial offset. China holds reserves, but won't release aggressively if instability benefits strategic positioning. Europe is already energy fragile. India imports over 80% of its oil. Pakistan imports nearly all of it. Within 10 days of sustained disruption, fuel prices spike, trade deficits widen, currencies weaken, central banks burn reserves. Oil above $160 for 60 consecutive days historically correlates with high recession probability. And here's the rehook. This isn't just about energy. Energy is leverage. And leverage changes geopolitics, because when oil spikes, some countries suffer and others gain. Russia does. At $170 oil, Moscow's fiscal position improves dramatically. Budget deficits narrow, war financing becomes easier, energy leverage increases. China doesn't benefit from higher prices, but benefits from structural realignment. If Gulf states begin hedging geopolitical risk by settling more oil in yuan, if even 10% of global oil trade shifts away from dollar settlement, that accelerates reserve diversification. The dollar still holds roughly 58% of global reserves, down from over 70% 2 decades ago. Energy trade is the backbone of reserve currency dominance. Disrupt energy, and you stress the currency architecture. Now imagine Gulf producers watching Hormuz become a battlefield. Would they diversify security partnerships? Would they hedge financial exposure? Would they deepen coordination with Beijing? These shifts don't happen overnight. They happen quietly, and they compound. This is how Cold Wars begin, not with speeches, with alignment changes. But here's the deeper risk. If the U.S. escalates militarily to reopen Hormuz, the confrontation widens, and widened confrontation redraws lines globally.
The United States has the naval capability to reopen the strait, but capability is not consequence-free. A direct confrontation risks missile exchanges, proxy escalation, cyber retaliation, and regional destabilization. Meanwhile, defense spending, already above $800 billion annually, rises further. Deficits widen, bond markets strain, gasoline hits $8 per gallon domestically, energy inflation hits voters. And here's the pattern. Every major oil shock since 1970 has reshaped domestic politics in affected countries. Energy stress translates into political stress. Now add global debt at record levels. Global debt exceeds $300 trillion across public and private sectors. High leverage systems do not absorb shocks well. They amplify them. Which brings us to fragmentation. Globalization was built on efficiency, cheap energy, safe shipping lanes, predictable trade corridors. Hormuz instability undermines all three. When corridors become risky, supply chains regionalize. When supply chains regionalize, costs rise. When costs rise, inflation becomes structural. And when inflation becomes structural while growth slows, central banks lose control. This is how systems fragment, not dramatically at first, but gradually. Energy blocks form, currency blocks solidify, security alliances harden. The world moves from one integrated network to parallel systems. 2 payment networks, 2 energy systems, 2 geopolitical camps. Not ideological like 1947, strategic like 2026. And once parallel systems form, reversal becomes difficult. If Hormuz reopens within 30 days, markets stabilize partially. But if disruption crosses 60 days, structural repricing begins. Oil above $160 for 2 months would likely push global CPI up sharply, drive bond yields above 5.5%, stress sovereign debt sustainability, increase recession odds above 70%. Emerging markets face immediate crisis risk. Currencies fall, capital flees, IMF negotiations multiply. Meanwhile, gold rallies. Energy becomes geopolitical currency. And here's the real shift. The illusion of energy security disappears. And once illusions disappear, policies change permanently. This isn't about one strike. It isn't about one leader. It isn't about one waterway. It's about exposure. Exposure of how dependent the global economy is on narrow choke points. exposure of how fragile debt-heavy systems have become, exposure of how quickly alliances can shift under stress. The new Cold War wouldn't begin with a declaration. It would begin with fragmentation, with trade rerouting, with bond yields rising, with nations quietly recalibrating. Hormuz is not just a strait, it's a hinge, and when hinges fail, doors swing hard. The world would not collapse overnight, but it would reorganize, less unified, more regional, more defensive, more divided. And once global systems fragment under pressure, they rarely return to their previous form. They evolve, and evolution under stress is rarely peaceful.